So very often you asking a question of what should I buy? I don't know right now maybe when to buy, when I do have a technical analysis tools, but I don't know what to buy among those hundreds of thousands stocks around. So I will make an approach most often by analyzing gauges on GuruFocus that helps me out with sorting out those elements together, but you may find out also at YCharts or any other website, as also even at the expensive one that is a Bloomberg terminal, to differentiate this quality stocks among the others. So thank you very much for tuning in. We are kicking off our series called Fundamentalists. Let's begin.
Firstly, I would like to mention the most favorite indicator of Warren Buffett in order to analyze the stock, which is return on equity. At first, I would like to discuss a return on equity indicator that is the most favorite indicator of Warren Buffett. Return on equity is a measure of financial performance calculated by dividing net income by shareholders' equity, and is considered a measure of a corporation's profitability in relation to stockholders' equity. So, as a shortcut, return on equity is calculated by dividing net income and average shareholders' equity. However, in order to find return on equity indicator the most reliable, you would have to analyze return on asset indicator as well. And return on assets is calculated by dividing a company's net income by total assets. You should really take a notice on return on assets to return on equity ratio when it is at a very low level, for example at 0.2 or 0.3. So due to this, if it's as low as mentioned, you should check the Altman Z-score, if it's helpful in this situation. And the Altman Z-score is the output of a credit strength that tests gauges a publicly traded manufacturing company's likelihood of bankruptcy. As a shortcut, investors can use the Altman Z-score plus to evaluate corporate credit risk, and a score below 1.8 means it's likely the company is headed for bankruptcy, while companies with scores above 3 are not likely as much. As an example, the median Altman Z-score of companies in 2007 was 1.81, which is very close to the threshold that would indicate a high probability of becoming bankrupt. As of next, I would suggest to check debt to EBITDA ratio. EBITDA is earnings before interest, taxes, depreciation and amortization. This ratio, debt to EBITDA, is a ratio measuring the amount of income generated and available to pay down debt before covering interest, taxes, depreciation and amortization expenses. This ratio measures a company's ability to pay off its incurred debt. High ratio result could indicate a company has a too heavy debt load. And another very important indicator is price to earnings ratio, that is the ratio for valuing a company that measures its current share price relative to its per share earnings EPS. However, when it comes to evaluating growth stocks, I would suggest using forward price to earnings. This is a version of the ratio of PE and uses forecasted earnings for the PE calculation. While the earnings used in this formula is just an estimate and doesn't give us a reliable historical earnings data, it's still beneficiary. Forward PE ratio formula is calculated by dividing price per share and forecasted EPS over the next 12 months. It's mentioned here also very important topic that is the PEG ratio that adjusts the traditional PE ratio by taking into account the growth rate in earnings per share that are expected in the future. This can help adjust companies that have a high growth rate and a high price to earnings ratio. The lower this indicator is, the better for the company and for the profitability of our investment.